Hello, everyone. I am Miriam Schwartz-Ziv from the Hebrew University of Jerusalem, and I am the co-chair of today's event together with Mike Burford from London School of Economics. We are absolutely delighted that you have all joined us today for the presentation of the paper, Institutional Investors in Corporate Governance, which we believe provides a deep and comprehensive, up-to-date overview of the role of institutional investors in corporate governance. We want to welcome all the many participants who joined us. I can see already over 150 participants with just a few minutes. Thank you for participating in the ECGI Spotlight Seminar Series. We hope you will enjoy it. The paper will be presented for the next half hour, and all three co-authors of the paper will actually take turns in presenting the paper. I think that's great. That way we can get to see all of them. The three co-authors are Professor Slava Fast from Boston College, Professor Amil Dasgupta from London School of Economics, and Professor Zach Sautner from Frankfurt School of Economics. After the presentation, we'll have three panelists that will each present their comments and questions on the paper. And we'll also do our very best to raise questions addressed by the participants. So if you have any questions, please, as we go along, just type your questions in the chat box, and we'll do our very best to address as many questions as possible. Whatever we don't have time to address, we'll pass on to the authors and they can think about your comments and questions. So thank you very much. I'm now going to pass the virtual microphone to the presenter. It's all yours.
Thanks very much for organizing the Spotlight talk on our paper, and a special thanks to Wei, John, and Amy for giving their time to give us comments. So this is a survey paper that aims to give identity to the growing area of research in the role of institutional investors in corporate governance. So there are three inputs into this literature. So chronologically, the law literature came first on this, and then there was an empirical finance literature. And then the theorists like me are often lost to the party, and we have, I think the theoretical part of this literature has grown in the last 7 to 8 years. But now having all three pillars together, it's quite feasible to, I think, give some definition to this area, and hence this paper. I should say that the survey is selective. We try to distill relevant lessons from the legal literature. We don't try to survey it. And even within the finance literature, we're quite selective in terms of focusing on things that look at institutional investors specifically. And then this talk, of course, is going to be even more selective. So really what you're getting is a very quick appetizer on the paper. I hope to highlight some of these themes and then hopefully tempt you to read the paper. Okay, so if we take a step back and think about the classical view of the role of blockholders in corporate governance. So the idea is that there are these managers, there's separation of ownership and control. There are these managers who are taking actions financed by their shareholders, which may or may not be optimal from their shareholders' perspective. Okay, so of course, unless these agency problems are perfectly corrected by either boards or by compensation contract, there's a role for owners of non-trivial amounts of shares to monitor management. There is, and this is done by voice or exit. There is a large literature on this. There are several surveys, including a recent excellent one by Edmonds and Holderness. So the canonical framework that these papers have in mind is the picture that you see in front of you, that there are firm managers who are taking actions. There is an agency problem. They may not be acting in the interest of their shareholders, and there are blockholders who monitor them. So keep that picture in mind just for the next 2 minutes while I tell you how that picture has evolved in recent years. When I say recent years, perhaps a sign of my age, in the recent 70 years, the ownership picture of corporate equity has really evolved. If you look at the household sector row in this table, you'll see that between the 1950s and a couple of years ago, the ownership of corporate equity has, by households that is direct, has reduced very dramatically down to about a third, of equity. And this direct ownership has been replaced by the phenomenal growth of institutions, mutual funds, ETFs, private and state pension funds, etc. Okay. So really, the picture in terms of ownership nowadays, even this is a simplification, obviously, is dual-led in the sense that there are these corporate managers who are making decisions. They're financed by equity holders. There are these block holders who may be monitoring them because of the agency problem. But these block holders are typically institutional investors who has this defining characteristic that they're using other people's money to own blocks. So they in turn are financed by their fund investors. Okay, so of course, if you draw the picture like that and you recognize that there's an agency problem between the block holder and the firm managers, then almost automatically you have to recognize that there must be a agency problem also between fund investors and their funds. Okay, and so that, in some sense, is a starting point of this of our approach in the survey, that the interaction of these dual agency problems is central to the role of institutional investors in corporate governance and forms, in some sense, the backbone, the intellectual backbone of our survey. So if we attempt to trace the fundamental consequences of the dual agency problem, we end up with the law in some sense, because it is because institutional investors manage other people's money, that they're agents themselves, that they're regulated. And this regulation, in turn, I'm going to argue, influences institutional structure, which then drives institutional incentives, their obligations, and fosters heterogeneity. Heterogeneity will be a sort of major theme of this talk. It's one of the themes that runs through the paper. Okay, so let me give you a little taster on how heterogeneity can arise and what the incentive heterogeneity and etc., how they can arise from the law. So at the broadest level, you might think that there is a dichotomy just in the basis of the type of capital being managed. So it's institutions that manage retirement savings versus institutions that manage discretionary savings are governed by different legal frameworks in the US. Again, this talk is going to be focused in the US, but the paper spends quite a lot of time talking about parallels in across the world. And these different legal frameworks then impose different obligations in terms of voting and reporting, and further, as we outline in the paper, these things evolve over time. Okay, now, even if you set aside this broad classification on the basis of the type of capital being managed, even if we focus in on the discretionary savings industry, there is something even more interesting, which is the institutional response in the form that the institutions take endogenously, respond to regulation and creates heterogeneity of another form. And in very broad brush, I would classify this response in two forms. So you have regulation takers and regulation arbitrageurs. So you'd have institutions that essentially embrace the Investment Companies Act and the Investment Advisors Act that's associated with it, get full access to the investing public. This is what I believe lawyers would call registered management investment companies, what the majority of finance lingo would call mutual funds and ETFs belong to this category. And then there are the regulation arbitrageurs who essentially organize themselves around exemption clauses, the so-called 3C clauses in the Investment Companies Act. They give up access to the wider investing public, but limit themselves to high net worth clients and accept marketing restrictions. And the majority of institutions that we think of as hedge funds belong in this category. So let me give you three little examples of how the legal framework impinges, therefore, differently on mutual funds and hedge funds. And you should think of these as labels in some sense for these two categories of institutions, not to be taken absolutely literally. So the first thing I'd talk about is incentives. So mutual funds have contracts that are governed by ICA and IAA clauses, which implies that a vast majority of them use rather simple proportionate assets under management fees. So they get paid for the amount of money that they have under management, which fairly obviously creates fairly pure incentives to compete for investor capital. So these institutions would naturally be unhappy with outflows. They should be naturally happy with inflows. Hedge funds, in contrast, have a relatively unrestricted contracting space, and therefore have more performance contingent contracts. They can have lock-ins, which gives them a much more nuanced relationship with competition for flow. For example, outflows are often mitigated by these lock-ins, but of course, future inflows are possibly attractive to hedge fund general partners nevertheless. So it's a bit more involved. And unlike mutual funds, hedge funds may have significantly more self-investment. I think that's empirically true, which also generates some heterogeneity in the incentives of the people running them. In a different form of heterogeneity might arise from the simple access issues. So mutual funds, by virtue of the fact that they can reach retail investors at the family level, certainly can actually be extremely large, and thereby have the option of diversifying the services that they provide to portfolio firms. For example, taking a piece of their 401k capital management services, which obviously represents additional sources of revenue to these fund families. But, and this has been a concern for some regulators, can also create additional conflicts which do not arise for other types of smaller institutions who, for example, cannot accept 401 capital to manage. And finally, changes in regulation also impinge sort of differently on these different classes of institutions. So for example, there's a much discussed update to the ICAIA in 2003 that, partly in response to the concerns that I outlined in the previous slide, requires mutual funds to report their proxy votes in a public manner, which obviously creates much more scrutiny for their public votes. And legal scholars argue that this creates a compliance challenge for them and actually induces them to use more proxy advisory services. And I'll come back briefly to some of the implications of that for corporate governance. A different legal modification, the 1992 proxy reform, may actually have been rather helpful to the activist hedge fund model, for example, by taking public statements and exempting them from proxy solicitation rules, which may have perhaps led to the uptick of the activist hedge fund industry in the mid-1990s. I haven't seen this much discussed in the literature, but I suspect that is quite a possibility. So in my last couple of minutes, let me just quickly give you, and these are just examples, a very brief helicopter view of how some of these themes have been at play in the recent literature. I won't get into any of this in any detail. I invite you to read the paper for that. So if you think about this idea that I've been talking about of competition for investor capital, which is quite a fundamental aspect of institutional investors and creates heterogeneity amongst them as well, when institutions compete for investor capital, of course, their governance actions will also lead to inferences by their investors, and therefore institutions would rationally think about the inferences that people might make about them from their governance actions, which will naturally affect the nature of their governance, more so for institutions that care more about flows than institutions that care less. So again, there is a discussion in the finance literature, both theoretical and empirical, that deals with this. There is a more subtle effect, which is that capital, of course, flows across institutions, from losers to winners, if you like, which then creates the intriguing possibility that that flows might actually be a way of linking together governance activities between institutions, either multiple at the same firm or at different firms, perhaps, but at the same time or at related times. and form a coordination device. And again, there is growing, more recent work in both theoretical and empirical literature in finance on this. And finally, coming back to this idea that the changes in the law can have interesting implications for the governance incentives of some institutions. The fact that the 2003 reform, for example, pushed for the use of proxy voting advisory services, as legal scholars suggest, that can create a significant correlation in the information source across institutions that are governed by such law, and can lead to externalities that can potentially also affect corporate governance actions. Okay, so heterogeneity has played a very repetitive theme in my talk up till now. So what I'm going to do now is hand over to my co-author Slava Foss, who is going to talk about how we document the heterogeneity in the US data.
Thanks, Amil. So I'll spend my time just describing some of stylized facts that we document in the paper. We based analysis on a few sources. The main source of data is quarterly Schedule 13F filings required by the SEC. In this paper, we use the version of these filings that come from directly from Edgar filings and not from Thomson Reuters. We actually want to thank Backus, Conwan, and Sinkinson for doing extremely important service to the profession and creating this database. As we realized, by just showing simple stylized facts, relying on clean data is very important because there are some substantial irregularities with Thomson Reuters. Our sample will cover period from 1999 to 2017. Some of results that I will be showing you will be done for the subsample of hedge funds that file these Schedule 13D filings, and it comes from a paper of mine with Vikas Agrawal and Jiang. In addition, for mutual funds, we will be relying on not only 13F filings, but also on CRISP survivor bias-free database, where we can see not only company level holdings, but also fund level holdings. In the results that I will be showing today, we will focus on company level holdings to be more precise. We will focus on four block sizes: 10%, 5%, 3%, and 1%. The existing literature has spent a lot of time on studying 5% block holders. 10% block holders are important because they become insiders from the point of view of compliance with all the requirements, just because they're too big. We believe there is not enough attention paid in the literature to 1% and 3% block holders. And why they're interesting? They're interesting because they're particularly relevant if you think about large corporations. This is where even large activists, when they want to engage with companies, will end up with one, maybe few percentage points ownership. Now, in addition, several theoretical papers predict that small blocks can be particularly relevant. For example, if you think about governance through exit, this is where interactions and coordination between small block holders can lead to substantial enhancement of effectiveness of that governance mechanism. Now, we will also see several recent papers emerging in the literature that show that small block holders interact, communicate, and often coordinate their actions when they engage in activism. This is why documenting stylized facts on these relatively small block holders is important. So in this figure, let me explain what you see. On the y-axis, you see the fraction of firms, of public firms in the United States with at least one block holder of a given size. So yellow line shows you the fraction of firms with at least one 10% block holder. Blue line shows you the fraction of firms with at least one 1% block holders. So there are two main messages that I wanted to see in this figure. The first one, all lines go they have positive trend, so suggesting that more and more firms have block holders in their base. Again, this is primarily driven by increasing the ownership by institutional investors. And it continues, you see, even during last two decades, the trend continues. The second stylized fact that I want you to see is that a lot of firms, almost all companies, have small block holders in their base. You see, if you go to the recent period, more than 80% of firms, actually more than 90% of firms have at least one 3% block holder in their base. So block holders are very common. Small block holders are even more common. Now, this table is the last one I'm going to show you, so let me explain it slowly. What do we see in this table? The unit of observation here is security and reporting quarter, and for the first two panels, and then security and reporting months for the last panel, where we look at mutual funds. And in this table, I show you summary statistics about the number of block holders of various sizes for that company. And I highlight here a few numbers in red. I want you to look at them. Let's look first of all at panel A, where we look at all types of institutions. When we look at the median number of 1% block holders, we see it's 9. What does it mean? That a typical company in US has 9 block holders that own at least 1% of shares. If you multiply it, you get the number of at least 9% of shares. 9% of shares is owned by these small block holders. The average number is 11.19, suggesting that on average, we have at least 11% of ownership controlled by these small block holders. Similar numbers you see if you go to 3% and 5% block holders. For example, if you look at 3% block holders, we see that on average we have 4.33 block holders. It means that they control at least 12% of ownership. So again, the fraction of ownership that is controlled by these block holders is very large. This is one point. But the second point is that there are many such block holders. Again, there are not just one, not just three. We have more than 10 1% block holders in the company. In panels B and C, we show you what happens if we focus on hedge funds and mutual funds. As Amil explained, these institutions have very different incentives. They have very different governance incentives. And we see that both of them have high level of presence in public domain. For example, the number of 1% blocks by hedge funds is 2.6. And by mutual fund is 2.48. For mutual funds, I report data here at company level, so it's aggregated from fund to company level. But you see they're comparable. So again, we have a lot of ownership control by block holders, and there is substantial heterogeneity. You see that about half of blocks is controlled by hedge funds and mutual funds, and they more or less equally split that ownership. And as we see in recent papers, these two types of institutions often interact when they engage with company. They have incentives to do it. And again, we show that there is a very robust empirical evidence that these block holders are present, and they become more frequently present recently. And it's true also for the small sizes. I think I'll stop here and hand a presentation to Zach.
So I think one nice feature that is important to point out here is that we're not trying to close this literature on institutional investors and corporate governance by kind of summarizing what has been done and kind of concluding that we basically understand what's going on. Right to the opposite. I think two important points to make is first that a lot of what we're doing here is building on what a lot of people have contributed to here, both in the theoretical and empirical literature. And I saw that quite a few people actually that worked very actively in this area among the participants and of course also here on the panel. So we're very grateful that we were able to put all this together. And then second, I think what we also want to point out, and that's kind of targeted a lot also to PhD students, is that especially in light of the recent theoretical progress that was made in this literature, there are a lot of open questions in this area that are worth pursuing, we believe. So what we do in the paper, and of course, we can only give you a teaser here also on the empirical side, is we provide this thematic overview of the empirical literature on institutional investors and governance. And as I just said, a lot of the empirical literature predates the theory, but I think this is actually the beauty of this, because the theory that is out there is opening up so many new dimensions that are worth pursuing in terms of reinterpretation of existing evidence, but also in terms of developing new measures, new proxies, and take them then to the data based on these new theory papers. So we focus in the empirical part of the paper on two ways in which institutional investors feature in this literature. The literature that deals with the classic theories on the role of institutional investors in governance, traditional engagement, activism literature, agency literature, but also, and that's a special emphasis as pointed out by Amil, the literature that deals with these institution-specific aspects in governance. So what I want to do here is provide you with two examples, two teasers, illustrating how this new recent theoretical progress can help us open up potentially exciting new avenues of research in this area. And I want to focus on the role of institutional investor horizon and institutional investor incentives. Let's look at the first aspect. So most of the work actually, including work that we have done, treats investor horizon largely as exogenous. So what we're doing is we're classifying investors ex ante, either by investor type or by measures such as turnover into long-term or short-term investors. And that literature has provided a lot of important insights, understanding the role of myopia, for example, on long-term investment, on M&A, etc. But as we point out in the theoretical part, the investor horizon is actually not a fundamental characteristic that is given ex ante to an investor, but it's an endogenous consequence of the incentives, which has this beautiful implication that there's a lot of heterogeneity even within an investor type, and even if you have a given set of churn rate, you still may have a lot of variation to exploit along the following dimensions. In terms of dimensions related to incentives to complete for flow, in terms of how much is locked up capital, how much is patient investors in the investor base, in terms of variation with respect to skin in the game. Right. So what we argue is that the growth of the theoretical literature here, highlighting all these dimensions of heterogeneity, may provide opportunities to both reinterpret the existing evidence and to consider new approaches, new metrics, new measures of incentives to compete for flow, of role of patient investors, skin in the game, and so on, and take that to the data. Second aspect is related to the incentives to engage. Like Amil pointed out, the theoretical literature shows this dual layered agency problem that may affect the incentives to engage, the governance role of investors. And so there's this heterogeneity, both due to direct and indirect incentives to engage, and they're very different across different institutional investors, giving them very different governance roles. So there's some first empirical evidence that supports some of the model-specific predictions related to these two dual layered agency problems, but there's so much more still to do, right? For example, to the best of our knowledge, in terms of quantifying flow-based incentives, there's only one paper that we could find, the paper by Levellen, that kind of provides us an assessment of how one could go with the data in order to measure these flow incentives, direct and indirect ones, right? So therefore, also here, a lot of important work still to be done. So flow motivations, as is shown theoretically, but still much more work to be done, empirically has nuanced effect on the governance incentives, which can be either negative by inducing short-termism or positive by inducing intervention, especially if you have these multiple blockholder regimes. But again, there's very little empirical evidence. So we can really take this progress and can say that, again, like I said at the beginning, we have not closed this literature at all, with summarizing what others have done. Instead, we want to incentivize people to push that literature forward, try to take serious the institutional features that are extremely important in this literature and the theoretical insights that were recently provided. That's it from our side. Thanks a lot for the opportunity to display our work, the work of many other people, and we're looking forward to the panel discussion.
Okay, thank you very much, Slava, Amil, and Zach. So now we move on to our panelists. So we have three panelists. We have Jiang from Columbia Business School. We have Amy Wilson from Federated Hermes, where she is, among other things, leading the development of the voting policy and the corporate governance principles. And then we have John Morley from Yale Law School. Let's start with J1. Please, Jay, the screen is yours.
Yes. Well, thanks for inviting me. And I certainly would, first, obviously, I would recommend this paper highly to any PhD student and junior researchers who want to get into the field. I also strongly recommend this paper to seasoned researchers because for people like myself, I also feel, even though I know many of the things bits by bits here and there, it's very, very refreshing to see everything so well organized in one place. I feel that it fills a lot of potholes in my own knowledge, as well as connect a lot of dots for myself. So thank you, the authors. So I think I would make two major comments. One is, what are the additional services that this paper can provide to the profession on top of what it already has? Now, for a long time, our literature has one control variable, which is called a percent of institutional ownership in every single corporate finance and governance regressions we have saying. Now, we come around to ask ourselves, what exactly does it measure? Now, one thing, after I read this paper, I almost feel like this practice should end because it's such a generic control. People thought it's control for corporate governance. It really doesn't. Now, this paper is telling us which one you control depends on what purpose of research you're targeting. It could be the percent of block holders, and block holders threshold could be very different. It could be percent of regulated capital. It could be the percent of capital that's competing for flow. So I hope that the authors could provide a clearer guidance for all researchers, under the sun, say, given this type of research, what's the best variable to put in your regression and how to construct these variables, or perhaps that you can share with the whole profession, that's even better. So for example, if I were to try to predict the probability of the proxy context, probably I should not control for just percentage of institutional ownership, but rather the percentage of about 1% block holders, because I'm thinking about how many presentations as a dissident I need to make. And if one presentation could persuade 1% of capital, that would dramatically ease the game. So this is kind of the guidance I would like to see more based on the current draft. And the second, the related one is the horizon. I really appreciate that the authors that lay out the nuances of the horizon, rather than just look at the ex post, the turnover ratio is a proxy for horizon. So we also realize that that practice is very, very problematic. So as the author pointed out, a trading frequency doesn't mean the trader doesn't care for the future. I think that's a very naive interpretation about what's observed in the data. But in fact, the trading frequency reflects the trader's perception of their resolution with some kind of mispricing versus the management's knowledge versus other market participants' knowledge. So it is the multiple layers of information asymmetry that will decide how quickly you want to unwind your position or how often you want to open up a new position for the active managers in any way. So I also think this message could be articulated more clearly and also give a little bit more guidance for the profession, for the literature. Say, if we do want to highlight the short-termism issue, how are we going to measure it? Because we don't want to continue the process of just controlling for the ex post turnover ratio and weighted at the shareholder base, because that's not getting to the bottom of the problem. Now, the third question is what I would like to add to the future of the research questions is the endogenous matching between firms and the type of shareholders. I think you touch on it, but haven't really extended in even though your papers are already 111 pages, because I can perceivably see that it could be across the life cycle, you know, as your newborn firm versus a growing firm versus a maturing firm versus a firm to be taken over by private equity, to be squeezed out for the cash flow. Now the composition of the shareholders will be very, very different, either by the regulation type or by the competing for flow type or by how nimble they trade. And also there could be a cross-sectional, maybe, you know, the high-flying firms versus struggling firms, and the composition could also be different. Now, big companies, so powerful corporate leaders, say Warren Buffett, he's an investor, he's also a corporate leader. Now, he would actively choose what type of shareholders that Berkshire Hathaway wants to have. That's what he called it, eugenics of shareholders. Now, I can also see such a strategy to be implemented by firm to a lesser degree, but it will have profound implications for the governance, because to some extent, you choose the type of shareholders you have. Another type of shareholders, I will call it a filler shareholder. They're very, very important because they're holding the shares there, but once there's a takeover announced, they immediately flip their share to the M&A arbitrageurs. When the firm's under activist arbitrage, they could quickly flip their shares to the wolf packs. So they're there to facilitate the transition of the shareholder from one base to the other in an efficient manner, because they're there to capture the price spread. So I think these are the issues that are super interesting, that we still call for theoretical modeling as well as empirical testing. So I think I will stop here and let the other panelists to chime in. But thank you so much for the wonderful paper.
Thank you. Very interesting points. Does one of the authors quickly want to respond to perhaps one or the 2 points? Thanks, Amil.
I can take a quick stab. Thank you so much, Wei. Those are very thoughtful remarks and overlap in non-trivial measure in some sense, and to things that we've wanted to think about but haven't made much progress on at some level. So one of the hopes of taking your points from the end in some sense is this issue of endogenous matching between institutions and firms, I think, is the most natural, open, theoretical question here. And it's in some sense that the endogenous block holding literature itself is, without thinking about institutional incentives, is quite daunting in some sense, and this would be a very natural direction to go in, but also a daunting one for this result. And now for exactly these reasons. And then when you think about the fact that, as you pointed out correctly, that there's the heterogeneity then creates an additional layer of richness to this. I think at some level, the sky's the limit for what one can do on this, but we, you know, it's a daunting challenge. I think on your first point, I think this is really great. I may want to turn this over to Slava or Zach to talk about, but one of the things that I think implicitly was our hope was that we might, by looking at all of this, get people like Slava and Zach who understand how to define these empirical variables, talking to people like me who write down models and get something out of it. So fingers crossed for the future on that. Thank you.
Amil, I will just quickly add, Wei, thanks for your comments, and I absolutely agree. And I think the good news is that it's also relatively easy for us to do. We can help the profession and make all these measures of number of blocks and trends, and we can make it publicly available, and hopefully people will start using it in empirical analysis. And of course, your points about variation in time series and cross-section, I think the literature should go forward with that.
Okay, thank you. Let's move on, please, Amy.
Hello, thank you for having me. I'd like to start by echoing the comments about the paper. I think it's a brilliant paper, very useful for me sat outside of academia and on the practitioner end to get such a systematic view, and particularly I think some of the context of the global differences. I spend a lot of my time engaging with firms in the UK, also Scandinavia, and a little in the US, but it's very useful to see some of the roots that sit behind the differences in terms of the governance landscape and firms' willingness to engage. So I thought I'd make perhaps 3 points, and before doing that, just give you a small amount of context about the organization that I work for. So Federated Hermes is an asset manager. I work for a department called EOS within Federated Hermes, and we are somewhat independent, deliberately so. So we are separate from the investment decision-making process. We are specifically tasked with stewardship, engaging with investee companies, and making voting recommendations. And we don't just represent Federated Hermes and those funds. We also have a client base of other third-party clients. Many of them are large asset owners, pension funds in the main, and all of them are united by a very long-term view and taking very seriously those drivers that we believe sit behind sustainable long-term value. So the first point I wanted to make, I suppose, is how we try to approach this question of interests, conflicts of interest, aligning interests. From our point of view, as a firm, we operate by a principle which we call holistic returns, which is that there is no point generating financial returns if over the long term, the damage to the natural world is such that it can no longer support societies, or the damage to the fabric of society is such that people can't enjoy a peaceful existence. And I think some of that is rooted in the history of the firm being primarily in service of pensioners and end beneficiaries, and that's something that we keep very much at the fore of our decision making. So for us, it's about taking that very long-term view. It's about being clear that all these different considerations are interrelated, and that there's no point prioritizing the financial over a reasonably short time frame, because it will all undo itself in the end. So to that extent, I think some of the descriptions in the paper of long-term investors being interested in ESG would absolutely apply to us. And I think the strategic and the financial considerations are also very important to us when we speak to companies, but we try as much as possible to look at those through a long-term lens. And our independence from the investment managers themselves, although we do collaborate and work together, is another attempt to make sure those potentially conflicting interests are taken out of the equation. And when we make decisions, whether it's in terms of what we engage with the company on, or indeed how we recommend voting, we try to think of the entire EOS client base as a whole and what is in their best long-term interest and the best long-term interests of the company. So I then thought I'd talk a little bit about voting and then things that go beyond voting. And I think, understandably, the paper discusses voting as quite an important part of the corporate governance sort of toolkit, I suppose, that institutional investors use. Like many others, we use ISS as an input alongside others, but we have our own voting policies. So we take ISS's research as an input, and we then we overlay that with our own policies. And in doing so, we are attempting to have voting be a continuation of the engagement we do with firms all through the year. But I think there are a number of factors for us that put us in a better position to do that than perhaps some other institutional investors. There are significant resource implications to having a team like the one that I'm part of. We are over 40 professionals dedicated to stewardship, professionals from all sorts of different backgrounds, many highly qualified, highly experienced. The other factor is universe selection. So we make recommendations on something like 10,000 meetings a year to our clients. Of those, we segment them into those that are put through without manual intervention based on our policies, and those that we engage with manually. And that's still a fairly high number, probably up to about 2,000 that we do that for. And I suppose that's the final very important element here, which is the importance of engagement. We've talked a little about information asymmetry, the power of actors like ISS and Glass Lewis. From our point of view, engaging directly with issuers and understanding the nuance that sits behind some of these issues is critical to coming to the right decision. Now, clearly we can't do that for 10,000 companies, so we select that universe. partly made up of those companies that are in our ongoing engagement program, and partly others where we're representing material holdings or there are material issues. And the final point I wanted to make was about the limitations of voting itself as an expression of institutional investors exercising their corporate governance responsibilities. And there was mention in the paper of other ways of using shareholder voice and engaging with companies behind closed doors. And I suppose I would say this, given that I come from a team dedicated to engagement and stewardship, but I would argue that the other types of engagement that we do with companies are in some ways, well, at least just as important as voting, and I would argue probably more important. The range of topics we can discuss with a company is much broader in ongoing engagement than voting. Not all issues lend themselves very neatly to voting. You know, when it comes to voting, we could have a say on the re-election of directors, executive pay, various other matters to do with the auditor, etc. It's much harder to have a more substantial conversation about human rights in the supply chain, for example. So whilst voting can be a useful escalation point for those concerns, we have the most substantive and meaningful interaction with and impact on companies through that ongoing engagement. And there's also something about time horizon. So, you know, we are very focused on long term. Voting is a moment in time. And actually, we believe that a lot of the most substantial work that needs to be done, often these things take place over a 3 to 5 year time horizon, maybe longer. So, you know, we're very involved in the Climate Action 100+ initiative. We're one of the sort of founding members of that. That is about pushing companies along a path to set very, very long-term goals to change their approach to CapEx investment, etc. So that would be my final thought, that voting is important, but it is not the whole picture of how institutional investors like us exercise those responsibilities.
Okay, thank you very much, Amy. Who of the three gentlemen would like to Zach, please?
Yes, I first want to thank you. I think these are great points, just want to mention first that I think your company is a prime example for an investor that is very open in interacting also with academia and sharing the data. I benefited from this, and I think there's a lot to learn, and others, you know, can confirm that. You know, Marco and so on, from looking at you know, this data from individual investors and how they engage and understand the processes and motivations that are behind that. And the second point quickly to make is we are of course focusing a lot on the G of the ESG letters, and I think what's worth pointing out probably a bit more in the paper is to what extent G differs from ENS. And I think one point that you mentioned correctly is that of course the incentives that you have when you engage over ENS are somewhat different than those with respect to G. The prime example is climate change, especially the long-term universal investors. Of course, they benefit from the externalities generated when they engage one individual firm. And that's somewhat different from the governance engagement where the externalities are a little bit lower. So I think that's certainly something we can emphasize a bit more in the paper. Again, thank you for the comments.
Okay, thanks, Zach. And John, please, it's your turn.
I also think this is a great paper, a really ambitious and impressive attempt to synthesize a vast and unruly literature, and especially impressive for its attempt to unify both legal considerations and economic considerations. That's something that's done too rarely, and it's something that's difficult to do because few of us have expertise across both of those sets of both of those academic fields. So the question I want to ask today is, what is the institution? And specifically, I want to focus on the distinction in investment fund management between the managers on the one hand and the investment funds on the other. And just so you can understand what I'm talking about, I'm going to put up a little diagram. Let's take an investment fund manager like, say, BlackRock, just by way of illustration. BlackRock is a business with its own corporate existence and its own set of owners. BlackRock manages, of course, many different mutual funds. It also manages hedge funds. So just by way of illustration here, I'm putting up an S&P 500 mutual fund, a corporate bond fund, and also a long-short hedge fund. BlackRock doesn't own these funds. Instead, it relates to them by a contract. Each of these funds has a contract that turns over to BlackRock all of the authority to manage the fund and operate its daily affairs. These funds will each have their own corporate existence. They will also each have their own distinct sets of owners. So no fund has the same ownership as every other fund, and each fund is a separate locus of fiduciary obligation for BlackRock. In addition, BlackRock might also have other business lines. It might do financial advising for businesses. If it were an investment bank, like say Goldman Sachs, it might also do derivatives underwriting and commercial lending and investment banking. And all of those will be in addition to its investment management operations. I've described this system in a paper called Too Big to Be Activist, as well as a handful of other papers. Now, the question I want to ask is, well, when we talk about an institutional investor, what are we talking about here? Are we talking about the management firm, or are we talking about each of the individual funds that it manages? Obviously, both of them are relevant, and I think it's important to think about both. It's also important to be precise which one we're talking about and to distinguish between the two of them. There are several reasons why this matters, why it's important to bear this distinction carefully in mind. And before I explain why, let me just present to you a simple example. So here's a company called Tortoise EcoFin. If you go to their website, this is what it looks like. And if you roll your pointer over investment vehicles at the top of the page, what you'll see is that Tortoise EcoFin is an advisor that advises lots of different kinds of investment vehicles. It advises separately managed accounts, which are just accounts that have one person's money in it, sort of like a bank account. It also manages closed-end funds, which are registered investment companies, open-end mutual funds, which are registered investment companies, interval funds, which are a kind of closed-end fund, private funds like hedge funds and private equity funds, exchange-traded products, and then also public investment vehicles in the United Kingdom and the European Union. And so it's important to bear in mind that we've got Tortoise EcoFin on the one hand and all these different other things on the other hand. And so why exactly does it matter? Well, the main reason for purposes of today is that reporting is often aggregated at the level of the manager. So if we look at Schedule 13F, for example, what we see is all of the funds reported just by the manager. So going back to Tortoise EcoFin, if we were to look at Tortoise EcoFin's 13F, what we would see is not a separate 13F for the open-end mutual funds and another 13F for the hedge funds. What we would see is a single 13F that reports all of those holdings on a single form in a single pool. This is a challenge for this paper because, as I understand it, and please correct me if I'm wrong, I very well could be, but as I understand it, you're combining three different data sets of 13F holdings. There's one that's sort of general. There's one that is unique to hedge funds, and then there's one that's actually not maybe 13F holdings, but it comes from a different form that's specific to mutual funds. And so if we look at Tortoise EcoFin, it might potentially be counted 3 times. First, in the basic data set where we include everything. Then second, again, when we include the hedge funds. And to be clear, when we include the hedge funds, we're including not just the assets specific to the hedge funds, but everything. Because if we identify Tortoise EcoFin as a hedge fund advisor and we look at its 13F, it's going to include not just the assets of the hedge fund, but the assets of all of these different vehicles. And then when we add in the assets from the mutual funds that are coming from a different form NPORT in the Center for Research and Securities Prices database, we'll be counting the mutual funds a third time. This is particularly concerning, I think, maybe for the 1% and 3% block holdings, because that's where the double counting issue could be most profound. And again, if I'm wrong, please correct me. There are other reasons why the distinction between managers and funds matters. So one is that clients of the same manager can sometimes work together on activism. So let's imagine, for example, that a BlackRock hedge fund wanted to start rattling the cage of some issuer. Well, not only could that hedge fund vote a certain way, but also all of BlackRock's trillions of dollars of other funds could vote alongside it. It could vote not just the $100 billion or so in that hedge fund, but the $1-point-something trillion in all of its other assets in favor of the hedge fund's activism efforts. Does it make sense then to distinguish between the hedge fund and the mutual fund and treat them as though they were different institutions when they can coordinate? I should say that this point is the implicit premise of the common ownership literature. I think without even realizing what they were doing, the scholars behind the common ownership literature treated a manager and all of its various clients as though it were the same thing. We tend to say BlackRock owns 5% of Apple Inc., when in fact BlackRock doesn't own anything. Each of its various clients do in much smaller shares. By saying BlackRock owns 5%, we act as if BlackRock were a unitary thing. But also sometimes clients and their managers cannot work together because their interests conflict. Let's imagine, for example, that a BlackRock hedge fund is invested in a company's debt, whereas a BlackRock mutual fund is invested in a company's equity. If the company is in financial distress, or if the equity holders propose to distribute a bunch of assets in a way that would diminish the value of the debt, well, now it's difficult for BlackRock to have those two funds work together because their interests diverge. The divergence can be especially problematic because of this aggregation and reporting I just described. Rule 13D, for example, imposes separate it requires a blockholder to report if it owns more than 5% of an issuer's shares. And the rules are very different based on whether the blockholder intends to exercise control or not. So if all of BlackRock's or all of Tortoise Ecofin's holdings are being reported on the same Form 13D, then if just one BlackRock client out of its hundreds of different clients chooses to exercise control, all of them will suddenly have different regulatory obligations. This means it's very difficult for a BlackRock fund to try to exercise control. So the bottom line is a client's behavior will depend on the character of its manager's other clients. We can't say categorically mutual funds behave this way and hedge funds behave that way, because sometimes they might be managed by the same person. And the fact that they're both together will influence what each of them individually can do. Now, let me say, this is not a criticism of this paper so much as just an extension of the spirit that motivates it. One of the things that I love about this paper is its attempt to distinguish and differentiate among the different kinds of institutional investors. That's a laudable ambition because too often we treat institutions as they were as though they were all the same things. And so I applaud the effort to distinguish and to bring greater clarity. And here's my small attempt to add to the spirit of the enterprise. Thanks.
Thank you, John. One of the authors wants to quickly respond.
Can I quickly just say about the first point about the data? Thanks for again, excellent point. I just want to make sure it's clear. There is no double or triple counting. The main analysis comes only from Schedule 13F filings. When we show it for hedge funds, we work with subsample of these filings that are filed by hedge funds. When we work with mutual funds, we move to a very different database at all. So, John, there is no double reporting of any blocks.
So just to be clear, in the 13F database, you're combining two different 13F databases, right?
Only one.
Okay.
Only one.
My mistake then. My mistake.
There's one sample.
My mistake. Okay.
Great. If I might follow up on Slava's comment, John, really wonderful comments. Thank you very much. I think that in many ways, as you were pointing out, that it's almost another dimension of heterogeneity that's built in here, which, as a result of the fact that the most general way of looking at these block holdings is 13F, and that there's a too high a degree of heterogeneity, we are subject to ignoring to some extent that degree of heterogeneity. We can do a little bit of work by sort of looking at a hedge fund database and looking at hedge fund holdings and mutual fund holdings, but broadly we are subject to that. So I think there is even more heterogeneity in here, and I think that if this is making a case for something, it's really making a case for financial economists and lawyers perhaps working more together on these questions. Thank you again.
Well, thank you so much. I want to thank all the panelists and the presenters for their responses. I really wanted to present some of the questions that were raised here, but unfortunately we're out of time. I will say that I personally also really enjoyed the paper, and I was actually curious about why the emphasis of the paper is about heterogeneity of institutional investors and not other type of investors that are not institutional as well. I'll send you some thoughts after the seminar on that. And I want to say that this concludes our ECGI Spotlight Seminar for today. We want to thank everyone who joined us today, and we hope to meet you all again in the future in our seminars. Thank you so much, and have a wonderful day.